Tangent Tank, Solving the Housing Crisis, a Tangent original series. This Tangent Tank dives into the world of prop tech companies tackling the housing affordability and supply crisis. Join our panel of judges, Jeffrey Berman, partner at Camber Creek, Zach Aarons, co-founder at Metaprop, and prop tech entrepreneur Edward Cohen, as we ask the tough questions and challenge each founder and evaluate their startups based on innovation, potential impact, and scalability. You'll listen firsthand from the founders themselves as they share their stories of determination and resilience. 1.8 billion people around the world do not have adequate housing. Housing affordability reached an all-time historic low in the US, as over 10 million renters spend over 50% of their income on housing. Amidst these challenges, there is hope. Across the world, we're seeking startups that leverage technology and talent to tackle this crisis head-on. If you are a passionate founder, please apply by emailing your company's deck or video to tangentcommunity@gmail.com.
Hi, welcome to Tangent. I'm Edward Cohen.
Hi there, I'm Jeffrey Berman.
I'm Zach Aarons.
Today on Tangent, we have Sukesh Shekar, founder of Altgage, affordable mortgages for everyone. Hi, Sukesh. Where does this podcast find you?
I'm based in Houston, Texas.
Houston, Texas. Awesome.
Fun fact, when I got to New York and I asked where Houston Street was, people looked at me super weird. And I'm like, come on, you can hear my accent. You know I'm not from here. Tell me where Houston Street is. And they were like, what are you talking about?
Did you tell them you're from the South and that's why you pronounce it that way?
I told them from the deep South.
The Deep South.
Anyways, Sukesh, so the housing market right now is like a hot pocket taken out of the microwave too early. It's somewhat hot, but it's still pretty frozen. I mean, we have never seen housing affordability deteriorate this quickly. I don't know who's buying a home right now. Mortgage purchase applications just hit the lowest point in 28 years. Home price to median income in the US is the highest it's ever been since we started counting 70 years ago. Sukesh, you've been working on Altgage. So tell us, how can Altgage help solve the housing crisis?
Thanks, Ed. Just a little bit about myself. I'm an immigrant, a PhD, and the founder of Altgage. And what I really care about is the American dream of owning your home. And like you correctly said, that housing affordability is in the shitter. And there are really two reasons for that. One is on the supply side of things, right? There's not enough supply coming on from both the builder perspective, and there's not enough turnover because people are locked into their low rate mortgages. It's called the locked in effect. But the second piece of it is really around, can you make mortgages affordable? And of course, at a very high level, the Fed does what it does and structurally rates are higher. But there's also a lot of fat in the mortgage market. I feel like there's no reason the mortgages shouldn't trade as close to the 10-year treasury as possible, which is what they're based off of. So what we've built is Deal Optimizer. It's the Google search of mortgages. Essentially, consumers enter, very simple information about their home, and we extract complexity to provide them essentially three simple options: a low rate option, a low cash to close, and the best deal, which is sort of this combination of low rates and down payments. I can go into a little bit about the tech, but at a high level, the benefits that consumers will get is a mortgage that's 1 to 1.5% lower than what they're getting on the market, and down payments that are about half the size, and then fees that are about also half. And I can go into the nitty-gritty details of how we do all that, but the reality is there's just a lot of fat in the mortgage markets, and I'm determined to cut right through it to get people the most affordable mortgage they can find today, given where sort of structural rates are.
So just so I understand this, and this is Jeff for people that can't differentiate between me and Zach. And again, you can't see us, but we're identical. Just for clarification, your company focuses on finding buyers a cheaper mortgage. Are you doing that? And when you say cutting out the fat, would you say that's like a race to the bottom on the fees that you're stripping out? In which case, I want to understand how you're making money. Or is there something specific in the way that the mortgage is structured that you're taking advantage of that other folks in this industry, some fairly sophisticated companies and entrepreneurs, have not been able to figure out?
All of the above. So we have built this rate optimization API, and the API does four things. The first is we reduce rate dispersion. So any mortgage marketplace, that's what they're doing. They're reducing rate dispersion by just quoting you rates from multiple lenders, right? But our technology starts where a marketplace ends. That's just the first step of optimization, right? The second thing we do is we go deep into the rate stack. So mortgage rates are not a discrete number. It's not like 6. You can get a rate of 6, 5.5, 5.25, 6.5. There's a cost associated with a lower rate and a credit associated with a higher rate. And what we do is we calculate the valleys in the rates, and essentially we skim to find rates that are cheap to buy. So we're not just looking at the headline rate, we're also skimming local and global minima to find rates that are super cheap to buy. And the reason this happens is because mortgages are pooled, packaged, and sold. So as these pools fill up, lenders will discount the ability to get into a certain mortgage pool. So we just skim, and basically we're buying mortgages on sale. That's step number 2. Step number 1 is rate dispersion, reducing that. Step number 2 is discount point optimization. Step number 3 is there are a lot of parameters in a mortgage that rates are insensitive to. So down payment, for example, is insensitive to rate. I know people think about LTV and such, but you can go from a down payment of 20% to 15% and your rate actually falls. I'll explain in a second why it falls. And then if you go from 15 to 10.1, it stays exactly the same because they move in these discrete buckets. So I can go from a down payment of 20% to 10.1%, and there's no effect on the rate. In fact, it goes a bit lower. And we do this essentially, programmatically to lower the down payment. That's step number 3. Then step number 4 is we unbundle and shop for PMI separately. The boogeyman with a down payment less than 20% is PMI, right? But right now, I can find PMI of $50 on a $500,000 home purchase if you're borrowing 10%. So basically, you're paying 50 times 12 or $600 a year to borrow $50,000 more dollars. The cost of that extra capital is 1.2%, right? You could just stick that 50,000 in Marcus by Goldman, collect 4%, and pay your PMI in perpetuity. So those are sort of 4 steps that we do programmatically to find essentially, you can get a quote for 6% with 20% down, or you can come to our sort of engine and find 5% with 10% down. And you don't have to explain this to consumers. Consumers just see a low rate mortgage with a lower down payment, they're sold. We don't have to explain how we're doing it, just sort of we sell them on value.
Well, you do need to explain it to us.
Yeah. And that's what I sort of just at a very high level did that. But there is another component of fees racing to the bottom. And I'd love to sort of explain something that I feel just burns me to my core on how mortgage brokers are compensated. Let me just ask, you guys are prop tech, investors. How much does a real estate broker or a realtor make, buyer or seller?
Some number of basis points on the mortgage.
No. A realtor commission. What is a realtor? What is
Oh,
realtor
like a real estate broker.
Yeah.
You make 2.5% each. Depending on the market, but anywhere between 2.5% to 6%.
Exactly. Average is still like 3%.
Mm-hmm.
Do you know how much a mortgage broker makes?
Less.
25 basis points usually.
How much?
25 basis points.
They make 200 basis points. The average mortgage broker.
So 2%, but it's still less.
It's less, right? But their job is also less. But do you know how they get paid? So how does a realtor get paid?
Once the transaction closes.
Exactly. How does a mortgage broker get paid?
If the mortgage gets originated.
Who is paying them?
So that actually depends.
It depends if it's conforming or non-conforming, right?
No, nobody freaking knows. So there are 2 types of compensation. It's called lender paid compensation and borrower paid compensation.
Or yeah. So that's what I was saying. It depends because on your settlement sheet, it'll say whether it's lender or borrower compensated. That's part of the negotiation.
No, it's not. Most people don't know that, right?
It also depends on state legislation, doesn't it?
No, in 95% of cases, it's lender paid compensation. So every single mortgage broker in America, 9.5 out of 10 take lender paid compensation. But the lender is not running a charity. So what they do is they bake in that into the rate. So instead of getting a rate, if you have a headline rate of 6, which is, sort of what the lender is doing, the mortgage broker will quote you 6.5%. And basically, it's sort of like you're trading, they will pay you 2% up front for getting the borrower to accept a 0.5% higher rate. And what that does is it's even worse than realtor compensation because a 0.5% higher rate on a mortgage translates to 10% more interest expense over the lifetime. So you could either pay the guy 10 grand up front or you end up paying 50 grand over the lifetime of the loan. And 95% of people, charge the 10 grand from the lender and then force the borrower to pay 50,000 over the lifetime. And this is not a choice. This is not a choice. It could be a choice if the borrower asks for it, but the borrower doesn't know to ask for it. So everybody just, basically takes him in the back and, screws him over a long time. So what I'm doing is that I'm testing this ethos, which is I believe, you know, broker comp should be borrower paid. And if you can see how much you're paying, you'll actually negotiate it, right? So we charge half, we'll charge only 1%, and we do it transparently in Section A of the origination.
Wait. Hold on. You want the borrower to pay the commission on getting a mortgage?
Correct.
What is this,
Why
New York
shouldn't they? If
City?
they're paying less money, why shouldn't they pay it?
Because I suppose if they're paying less money, but I think the like the syllogistic end to what is happening here is the lenders are going to say, well, wait a second. Okay, so the borrower is paying the fee to the broker. Why don't we just cut out the broker completely? Borrower doesn't have to pay anything, and now they feel like it's even less. So the borrower gets, so the broker is out. The lender makes their loan. The borrower takes the loan. No broker.
That doesn't work. So the largest lender in the country is Rocket Mortgage. They were a full retail shop. They were, essentially there. But then they realized they couldn't expand business, so they opened up the broker channel, and now they do like, essentially an equivalent amount of business with the broker channel. Same, concept is, at some point there's a touch point with a mortgage broker. I agree with you, and my goal ultimately is to drive fees from 1% to 0.1%, have it be fully API based. But it takes time. It takes time to figure out, how you do that. And you're right. That's the hypothesis I'm testing. Will people accept it? We launched it last month. We're 20 loans in. Not one has even asked the question, what is this line item? Because of all the other things my optimization engine is doing, they were like, oh, I got to pay 100 grand. You're saying it's 55. Great. I'm paying 55 with a rate that's 1% lower. Like, they're just looking at the headline of what's my cash to close and what's the rate that I'm getting. But usually you have them at like the rates with a 5 handle while I'm getting quoted 7.
And so essentially you're stepping into that fee position, that mortgage broker position, and saying, look, lender, you're going to give me a lower rate because you're no longer going to have to pay me. Borrower, you're going to pay me because I'm getting you a lower rate.
That's what's happening, but you don't even really have to have the conversation with the borrower because they're just seeing a low rate and they're
No, I understand that. I just want to make sure I
Yeah,
understand it.
that's
Because
right. That's right.
unlike my friend Zach here,
That's right.
I do not have a PhD.
That's right.
I don't have a PhD.
Yes, you do.
I
You're a
don't.
doctor and awesome.
Yeah, thank you.
Parking policy has become a huge obstacle across many cities. Whether your city needs comprehensive traffic improvements, more bike lanes, or more housing, parking policy is always in the way. The Parking Reform Network is here to support real estate professionals and community members working in any discipline impacted by costly parking mandates. Car dependency has played a big role in suburbia. It has also played a major role in the story of how we ended up with inefficient sprawl, climate change, and a housing crisis. By reforming how our cities work and to what land uses we dedicate our spaces to, the Parking Reform Network helps make progress on our climate, transportation, and housing goals. Now you can also have a positive impact on your community's safety and quality of life through research and collaboration. To get involved, please visit parkingreform.org. To learn about the Parking Reform Network's resources, please visit parkingreform.org or follow them on Twitter at parking_reform.
You talk about 4 phases,
Yeah.
and I heard a lot of terms that I don't think rightly the average person knows, like
Sure.
market rate dispersion. Can you explain that? Like this is something that I think is top of mind for not only investors like me and Zach,
Yeah.
but also for borrowers and for banks and for, I don't know, the federal government.
Sure.
I think we should pause for a little tangent glossary section where you can run through
Yeah.
some of the key terms. Yeah, so just go through, Sukesh, the 5, 6 main terms that you were talking about that may not be familiar to lay people.
Yeah. So let me break down the first one, which is people say you should shop for your rates. The question is, why are you shopping for your rates? Right? Because there's variance in rates. So, dispersion is just a measure of like how variable is. Somebody's quoting you 5.5, somebody's quoting you 6.5. And you got to think about it like if I get 3 quotes, there's a 90% chance that I don't get the worst rate unless I'm super unlucky and always pick high cost lenders, right? And then you have to think about why is it that rates vary so much, and that really just breaks down into like what is my cost of capital, which is where am I getting the money from, and how efficient am I at originating mortgages. So one of the reasons, if you go to a large lender, right, your structural cost of capital is going to be lower, right, because they're doing a lot of loans. But step number two, these folks also tend to have very high operating costs. So your goal when you find a low rate lender, it's two things working together, which is they're doing a lot of loans and they're operationally efficient. Better.com is none of those, right? They are not operationally efficient, right? And they do $20 billion in loans. Rocket Mortgage does a quarter of a trillion. So Rocket Mortgage typically has the lowest rate, or UWM, if you go to any pricing engine. UWM stands for United Wholesale Mortgage. They're the largest wholesaler in the country. Actually, let me do one more glossary, right? And the glossary is there are three ways in which you can get a mortgage. The first one is you go to your bank, right? You just go to your bank or credit union. That's the first way. The second way is you got a guy, and the guy is usually referred to you by a realtor or somebody. That's a mortgage broker. So when you go to your bank, that's called retail. And when you go to a guy, that's essentially wholesale, right? So, but that wholesaler, the broker, they don't have money. They're just connecting you with a wholesale lender, but they're basically the marketing and sales operation. Versus a retail bank is doing their marketing, sales, and lending all together. So if you think of like lending, marketing, sales, a retail institution is doing all three. A wholesaler is just doing sort of the lending, underwriting, and then the broker is doing the marketing and sales.
And then you mentioned PMI as well. Can you explain PMI?
So PMI stands for private mortgage insurance. On a conventional loan, so conventional loan just means it's below a certain size and that loan is sold to Fannie and Freddie, which are two government-sponsored enterprises. We may need a little bit of glossary there too, but essentially this is the bread and butter loan. So when you take a bread and butter loan, if you put less than 20% down, you have to pay private mortgage insurance. And that mortgage insurance, you are paying it, but you're not paying it to the lender. You're essentially paying it to an insurance company that is underwriting risk that in case you default, they will pay out the lender. So essentially the lender is, just buying insurance for themselves, but the home buyer is paying the insurance to effectively insure the lender. Now, PMI is often the boogeyman, right? Like your grandpa told you, or your dad told you, somebody very old told you that, you should always put 20% down. And that worked when home prices were 150,000, right? Now the average home price is over 500, depending in Miami, it's like probably 900. Nobody has $180,000. Like I worked at McKinsey for 6 years, like I was a junior partner, like my colleagues, even they don't have $180,000. Like nobody has $180,000, right? So everybody is at some level going to pay PMI. But the key is you want to find, just like you shop for car insurance, you want to shop for cheap PMI. But what lenders do is they just give you a shitty PMI provider. And what you really want to do is like get a super cheap one. So the key in finding an affordable mortgage is A, getting a structurally low rate from somebody who does a lot of loans. B, they're an efficient shop, so they don't have a lot of fat in the marketing and sales. And C, you also want to get low PMI. If you manage to assemble that, you're cutting out mortgage rates at every single level.
Can I shift directions for a second? So
Sure.
you're essentially what you're doing is there's a lack of transparency. Obviously, there are a lot of middle people in the process here. You're adding transparency and you're enabling the end customer, the borrower, to shop for all types of things, which ultimately lower their rate. And the competitor, which is either a bank or a broker, is bundling everything together, making it more opaque, obfuscating it, and therefore making it more expensive. And so you are enabling home affordability because you are enabling less expensive mortgages. You're cutting the fat out of the mortgage cost. Is that correct?
That's correct. And at every level, like, I made like an issue tree when I got my own mortgage.
I appreciate that. I'm even willing, unlike Jeff. So Jeff is a real VC, looks at things like numbers and discounted cash flow analysis, and he digs in. He once called the CTO's second grade science teacher to make sure that this person was really good at C++ back in the day, right? But like for me, I'm more into like existential issues, big things. I get bored by things like numbers. So I just read a stat though, and it said just existentially for this business, there's no doubt in my mind it's a great business as it relates to being a more efficient mortgage lender. I think my issue existentially is I just read a stat that said even factoring in modest home appreciation assumptions, it's now cheaper to rent because of how where interest rates are, it's cheaper to rent in 95% of major U.S. markets than it is to own a home. And you mentioned at the beginning of the call that the American dream is home ownership. And so, in my opinion, I'd like to challenge why that is. Is that something that was fed to our forefathers in this post World War II Coca-Cola, McDonald's, white picket fence package that, to your point earlier, today is no longer working? And maybe instead of recalibrating everyone's mortgage payments and fees, we should be recalibrating people's assumptions toward home ownership equaling the American dream. What's your response to that?
It was in 1913, Woodrow Wilson, under threat of communist Russia, sort of, came up with the FHA and instilled this idea of the American dream. And the idea was if people owned their home, they wouldn't turn into communists. They have their sort of, they have their sort of place under the sun, right? But if you think about, value, right? The value of a home goes up for two reasons. One is land is a finite resource. Do you know who the largest landholder in the US is?
Well, hold on, let me guess. So, aside from the federal government, I would say Ted Turner, the Catholic Church. Let's throw out something weird. Maybe.
The Mormon Church.
Oh, you know what? Not no. Mormon Church. And let's do something weird for the fourth one.
It's Bill Gates,
Dame
right?
Judi Dench.
Bill Gates, ostensibly, he's the largest landowner in the country.
He's
He owns
he's the largest landowner.
Yeah, he owns something like like a
Larger than
percentage
Ted
of
Turner.
U.S. farmland, in
Yeah, my
Ohio.
understanding, by the way, is John Malone is now the single largest owner of farmland. However, these ownership structures, we shouldn't belabor it since we're up on time.
Yeah.
These
So
ownership structures are heavily shrouded in multiple layers of LLCs, so it's hard to know.
It's hard to know.
It seems like this is not true. The largest landowner.
Wow.
So it says
Emerson family.
So
But John Malone is
yeah,
on
John
our
Malone.
list.
John Malone is just
Anyway,
below
all the
them.
above.
They're at 2.3
and
million
gaining
acres, and
quickly
John
on
Malone
them.
is at
Yeah,
2.2
gaining
million
quickly.
acres.
Anyway,
Those are families.
the Emerson family. What point were you going to make about the Emerson family, Sukesh?
Oh, they're a family. It's sort of like is the richest person or family. So the point I was trying to make is if you want a more equitable country, right? The way to make it more equitable is not by taxing the rich, it's by raising the base. And the number one way in which you raise the base wealth in the country is by getting people to own some piece of land. Right? The value of the home on top of it sort of just appreciates with inflation, but land is the only thing, right? Because it's a fixed amount, it will go up in real terms, right? And not everybody's a sophisticated investor. You guys are VCs, you have access to a lot of different deal flow, but the OG deal flow is buying a piece of land, right? If the moment you buy a piece of land and build something on it, you have now created a base level of wealth, right? It's not, and that never happens in renting. It's true that maybe on a cash basis, yeah, renting might be cheaper, but then you also have to also assume that people are taking the difference and investing in the S&P and not trading, right? So there are a lot of other things that have to happen for that wealth to come up. Versus if you buy a home, you are going to build wealth. If you look at intergenerational wealth creation, it's the difference is home ownership.
I wanna hone in on Zach's point here. So mortgage rates currently are back above 7%, which means that at that rate, buying a median home in the U.S. is above $450,000, or that means around a down payment of $90,000 and over $2,500 of mortgage payments. I would love, for this historically, wealth generator to be one again, right? However, we live in a fundamentally different society with a lot more people, and with everyone just moving more and more to the cities, even though during COVID we saw a little hiccup there. But yeah, in terms of setting this promise, I completely see the information asymmetry that is in the mortgage industry, and how there's maybe a lot of inefficiencies that we could solve using technology or using just more fairer models. But at the very core, yeah, I'm just worried about that supply-demand, imbalance.
Hold on. I want to go back to the point you just made, Sukesh. Not what Edward said, notwithstanding, but you made a blanket, because this goes to the heart of Zach's question. It's not the land or the home. It's some asset that people own as a base of wealth. That's the word that I want to debate, because this notion of hard asset, when somebody buys a condominium and they're sitting on a piece of land that 100 other people have a stake into, that is not, I think, what you're referring to. You're referring to the homestead where Ma and Pa have their cows and their sheep and their chickens, and they're toiling in the land, and the value is accretive to them because we're not making more land. We're not in the GCC. We're not putting islands in the ocean. But when you look at cities, which is where the affordability crisis really is, you're not buying a piece of land. You're buying a sliver of a sliver of a sliver on top of other people who are buying slivers and slivers and slivers. And so I have an issue fundamentally with the notion that which I'm pretty sure Woodrow Wilson didn't envisage when he created the FHA, that is I think is a disconnect, because now the opportunity for people to own various different types of assets, I'm not going to call them hard assets, building a wealth base, the ability for people to access such is so much more than it was 110 years ago.
No, I agree with you, but not in a risk-free way, right? Like when you buy a home, right? It's as close to risk-free. Home price appreciation is effectively guaranteed because land is.
You lost me there. You lost me there. This might be, hold on. I in 2008, when the last real estate crisis happened, there were homes that were built in the Everglades in Florida. They should never have been built. You're telling me that if someone bought those homes, oh yeah, that never goes down in value.
Look, we're talking about a Swiss cheese model of market failures, and there was basically fraud in the mortgage markets, right? And mortgage brokers were getting paid for checking no documents, and they're like,
I'm not talking about that. I'm talking about the fundamental point that you're making, that only homes are the only assets that never decrease in value. That's just simply untrue.
in a 10-year cycle, they've never been known to decrease. If you look at 10-year home price appreciation, home values have never decreased.
I would say if you look at areas of Michigan or areas of Pennsylvania, that is untrue. I think if the economic drivers are not there, then the value of the homes.
Yeah, I think it's less the idea, because I can, to Jeff's point, right? If you had, you can put the money in bonds, and you have a way more sure income stream. So it's not then, yes, you do. If I buy treasury bills, that is way less risky than a home. That is not.
Not in real terms. Not in real terms. Look at what happened to the bond market when prices.
I would
rise.
argue yes in real terms, but let the issue is with the liquidity. What owning a home does, and in my opinion, this is unfortunate at times, it locks people in, whether real or not, to the idea that they can't sell it or they shouldn't sell it. And because of that, it's similar to being a VC, where I'm sure there are times, Jeff, where you would love to have liquid equity on some of your positions and sell them, but you can't. And the fact that you can't, and you don't pull the trigger and sell too early, is what fundamentally creates the wealth. And that's a nuance that people unfortunately don't understand. So I would argue it's not the appreciation. And by the way, there's no guarantee you're gonna have appreciation. And I would like to, for next tangent, we should do some research on that 10-year appreciation thing, because I also don't believe it. I can fundamentally, anecdotally pick a bunch of markets out of my head right now where I know that not to be true, including points in time in Vegas and Phoenix and all over the country. But regardless of that, the issue is effectively that owning a home has been a force function for people to hold on to assets multi-generational in a tax efficient manner. However, I would argue if somebody had the discipline and the patience to hold an annuity or a fixed income portfolio, they would get a arguably better return with less risk and less hassle, because they wouldn't have to own a home.
Right. Yeah, I mean, according to national appreciation values, average around 3.5 to 3.8% per year. But I'm sure when we zoom into different markets, we'll see drastically different realities across time as it is
Yeah, and there's it's not like the bond market is totally risk free, right? There were a lot of senior citizens who were told to buy long-term bonds very recently because they're retirees. They saw last year the value of those long-term bonds decrease by 25 to 30%. These people are not going to live long enough to see maturation at par on those things. So I agree with you partially on your point about the real appreciation as inflation adjusted. Um, and fixed income is far from risk free.
The 60/40 portfolio, which is sort of the classic portfolio, right? It had the worst performance in like something like 100 years last year. But look, my point is they are, buying a home, it may not be the most like efficient way of building wealth, like maybe VC, right? Like much more asymmetric outcomes, but it is the most effective way, right? It's like the most guaranteed, simple way that you don't have to spend a lot of brain power to build it. And a mortgage is just key to that, right? So you know, I'm not building a wealth management tool like
Right. And because you are right about that, and we've gone on a pretty long tangent, I want to understand specifically how you do what you do. Because in order for your company to be investable at a venture scale, people like Zach and me need to believe that what you have created is not just a better mousetrap that someone can't copy, but that it is repeatable, scalable, and that you have protectable IP. So let's go for it. Let's hear it.
Yeah, and it boils down to unit economics. Like, even if you can get all your customers cheaper mortgages and your product's easy to use, people still have to find your product, and it's a very crowded market.
Yeah, so I'm doing three things that are non-traditional, which is I'm not advertising. So the first thing that I'm doing is I reached out to NAR, we're in talks with NAR, and we can see, can we create a relationship and embed our rate engine into every realtor's website, right? Because ultimately they are the source of trust. And the value prop to them is very strong because we're increasing their customers' capacity to borrow and likelihood to close the deal. Because a lot of people are scared and stepping out at 7%. We say, hey, rates are still at 5.5. The likelihood of them continuing to engage in the conversation is higher. So essentially, our realtors are our sort of sales and marketing engine, not the mortgage broker. That's number one. Number two is I'm mining title data. So essentially, I'm buying title data at like 3 cents a pop, and then I'm mining it to say who are the specific sort of ideal customers that I'm going to reach out to and say, hey, we should do a refinance. The mortgage insurance premium drop 0.3%. Our rate is 0.5% lower. We'll bring you a 0.8% reduction. And then I'm doing a combination of text, email, and direct mail marketing. And then step number three is, I'm working with different corporate partners in Houston. I've reached out to like an ExxonMobil or United Airlines, my own former employer, and we're saying, hey, this is an employee benefit. If you contribute X%, if you do 1%, we'll essentially do the mortgage for free, right? Because that's all I'm charging. So I'm just taking essentially B2B to C levers. There's another one where I'm talking to various startup founders who are doing interesting things, and it's a couple of conversations, and they're sold on the idea because they might be building a design custom builder, or they're doing like rental rewards, and we're just attaching the mortgage on the back end, with just structurally lower rates.
Interesting. And what is the protectable IP?
So the protectable IP is, one is sort of our rate engine, basically how we optimize things. But look, I fundamentally believe, the only comparative advantage is the pace of innovation, right? It's like first we built this smart payments algorithm, then we built two other things. So it's just sort of like how many pieces of innovation can you stack on each other? So the complexity increases. The complexity of copying it, just sort of increases, right? Sort of it's like the square, right? They I think it's called innovation stack. I like that idea. It's like just keep innovating.
So can you take us through your innovation stack? Because I think, and this is just an angel investment for me, but I invested in a mortgage company. I will not say its name because I don't think it's going very well. And fortunately, it was a very small angel check many years ago. But Zach, I don't know if you guys have invested in any mortgage tech companies. Have you?
We've done about 12 to 15 mortgage tech
How are they,
deals.
how
Yeah, so we've
and how are they
invested
doing?
extensively. So, I mean, what's been interesting when the market was booming, our tech enabled originators and brokers were booming, and our companies that sell marketing tools, SaaS, lead gen, back office, workflow SaaS to existing lenders and servicers, they couldn't get anybody on the phone because they were too busy doing loans. So now we've seen that flip a little bit, and obviously people who originate or broker are struggling, and people who are, because just volumes down, right? So it's a game of gaining market share while the market stays bad and figuring out how to get through it. But the more of the like SaaS and like lead gen and market martech companies in the mortgage space are actually thriving, because all the existing incumbent lenders and originators are like, oh God, I now have to actually work for my lunch now. And so they're interested in things like lead gen to get more customers, and they're also interested in cost savings, right? You're seeing.
But that's more on the service side versus like what Sukesh is building or has built.
No, it's origination and brokerage too. We have companies that sell into large originators, whether it's like a firm like Wells or something, and those companies are seeing traction because just, the originators just weren't available to learn about the software for the past 2.5 years. But no, it's not. Yeah, it's tough. Obviously, it's tough for everybody across the board for sure. In residential and commercial mortgage, and then also everything that's a business ancillary to it, right? And that includes title, that includes appraisal, right? That includes, so anything sort of connected to that closing statement you were mentioning is obviously struggling. There are fewer closings.
Sukesh, I think it's worth zooming in for a minute in that particular innovation where you mentioned that the typical search when you're searching for rates in a mortgage is a horizontal search, but you're implementing a vertical search where you're able to take advantage of other elements in the real estate, in the housing cycle.
That's right. So what I mean by a vertical search is, mortgage rates are published in a table. Nobody sees the table because, they just publish like one rate, right? Nobody sees the table. But what this table has, of course, it has your rate, it has your payment, it has your taxes, whatever. But next to the rate, there'll be a cost associated with the rate. And essentially what we're doing, we're running a very simple, like, function that says dy by dx, right? Where is it the cheapest to buy this rate? So it's basically automated rate selection based on where it's cheapest to buy the rate. Now, there's a fair amount of orchestration you need to do there. You need to get all the lenders, you need to source them, you need to put on the table. But fundamentally, we're picking out valleys in rates. Where is it cheap to buy? And that no pricing engine does. Because what the pricing engine does is like, let's say, here's the rate, you can pick it, you can do the calculation, and some mortgage brokers will do it, some won't. But the fact that we do it, like, it's just a very simple optimization, yeah. But the key in the innovation stack is not that. Like, that in itself, somebody could reverse engineer it. Once they figure out what we're doing exactly, you could. But then the fact that we're unbundling and rebundling PMI, right? We're also, another part of the optimization is we are looking at insensitivity to rates, not just sensitivity to rates where the cost is low, but insensitivity rates, because the other big barrier is down payment. So our ability to lower the down payment while lowering the rate at the same time, from portfolio theory, it's like a more efficient frontier, right? Which is like, can you lower the rate, the down payment, the PMI all at the same time? And what we're doing is we're just pushing out, the efficiency of the mortgage coupled with transparency and lower fees.
And how big is the team that it takes to do this on the product side, engineering, marketing?
3 people, right? Because we use Plaid, we use Method Financial, it's an embedded debt API. We use Mortec to get our rates, right? And we have these little pieces of code, you can think of as like a couple of microservices that we've built, and then just all stitched together with a consumer-facing front end, right? The key is to be super lean. Like right now we're talking with Flagstar, they're the nation's 3rd largest servicer, and the idea is like, can we embed our smart payments API? We might publish it on Staircase, which is sort of a mortgage, API. They're like the AWS of mortgage, right? And I would love to sort of even expose our things, because I don't think I can scale to like 50 million people. So I just want to get people the cheapest mortgage as fast as possible. So
Zach, aren't you in Staircase?
Look at that. Indeed, I am, Jeffrey.
Bam!
A close friend of mine from business school is the CEO, and a former Blacklight executive is the CTO. It's an excellent company. I will set you up. We can go on a tangent and make
Did
that.
we just make a shidduch here? Is that what
You
happened?
did. Indeed, you did.
By the way, for anybody who doesn't know, a shidduch is Yiddish for connection that usually leads to marriage, but we'll see if Sukesh has what it takes. Stay tuned. Well, Sukesh, thank you so much for joining us. I'd like to look at your company, and I'm sure I can't speak for Zach, so I'm not going to say that he would like to look at it too. But now I kind of forced him to say, "Oh, I'd like to look at it too."
I would be very interested in preventing Jeff from obtaining an allocation and just blocking
Bam!
completely.
I love it. How do you say that to your doppelganger? Is that nice?
I know it's horrible.
Well, we're going to look at it again. Like we said at the beginning of the episode, this is not a solicitation for investment. This is a conversation between old friends and new friends. But we hope everyone enjoyed this as much as we did. This was awesome. Sukesh, thank you for being a good sport.
My pleasure, TV.
To learn more about Sukesh's company Altgage, please visit deal.altgage.com. That's deal.altgage.com. Thanks for tuning in to Tangent Tank, solving the housing crisis. Don't forget to follow, rate, and review Tangent and share this episode with a friend. This series is edited by Daniel Mora and produced by me, Edward Cohen. Remember, collaboration is our superpower, so stay curious and always be learning.